Hi there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you now in the BNN Bloomberg newsroom. The Canadian economy lost more jobs than expected last month. Data from StatsCan shows the labor market shed 17,700 jobs in April. Economists were expecting a gain of 10,000 positions. The unemployment rate also rose to a 6-month high, hitting 6.9%. The decrease in employment was predominantly in full-time work. And the federal government is aiming to speed up reviews of major projects to 1 year. Trade Minister Dominic LeBlanc says Ottawa will launch consultations on proposals to fast-track federal assessments of major projects and will engage with Canadians over a month-long period. Ottawa is proposing to ensure federal reviews and decision-making timelines take no more than a year once all project information has been submitted. And shares of Aritzia are rising today. The retailer posted profit in its latest quarter that surpassed estimates and also beat on revenue, with that metric jumping 33% versus the year before. There was also a surge in revenue in its retail and e-commerce segments. Aritzia also issued a revenue outlook for 2027 that beat expectations. The results come as Aritzia continues to open more boutiques and push an app that it recently launched. And we're, of course, watching the TSX today. It is climbing. It's still below 34,000, but up by 0.4% at the moment. A similar story in the U.S. today. We're continuing to watch markets there. It seems as though mixed trading now. The NASDAQ is up well over a full percentage point. The S&P 500 also extending gains. At the moment, though, the Dow Jones is down ever so slightly. Well, the Canadian economy shed nearly 18,000 jobs in April. That's according to Statistics Canada. Meanwhile, the U.S. added more than 100,000 jobs last month. So let's bring in Jordan Jackson, global market strategist at J.P. Morgan Asset Management, to break some of this down for us. Thanks for joining us. Appreciate your time.
Thanks for having me.
So I'm wondering, what do you make of kind of the disconnect here, what we're seeing in Canada when it comes to jobs and what we're seeing in the U.S. when it comes to jobs?
Yeah, so it's really interesting when you kind of peel back the onion. We still have a healthcare sector that's adding jobs, while the federal level here in the U.S. continues to shed jobs on balance. I think coming into the year there was a lot of concern around the strength of the labor market. I would say that this in the U.S. is a tight labor market, not necessarily a strong labor market. On the other northern side of the border, right, I think what we're seeing is some kind of continued slowing, coming from the Canadian economy. We saw slower growth last year and the very beginning of this year, and that's just weighing on broader activity. Obviously, trade and now the conflict in the Middle East are all causing concerns around the overall outlook on a go-forward basis. And I think all these things are contributing to the business uncertainty and that contributing to kind of the weakness that we're seeing in the labor markets.
Interesting. You mentioned for the U.S. it was tight market, not a strong market. What do you mean by that?
Well, we're seeing, both sort of broadly, I would say over the last 6 months or so, weakening in the demand side of the equation, but also weakening in the supply side. And that's really the real reason why the unemployment rate hasn't moved much higher over the last several months, where we've seen job growth kind of weakening out a little bit. It's the last 2 months have been strong, but on balance over the last 6 months or so, this has still been a labor market that has been cooling here in the United States. So again, I wouldn't necessarily say this is a strong labor market, but certainly one that's tight.
I wonder what this does then for the path ahead for the Fed, for example. I mean, because I know we're going to talk today about, Kevin Warsh, the new term potentially coming up. There's a vote on May 11th, I believe. Do you think that now maybe there's more talk of rate hikes, or what do you think is going to happen there?
I think the bar for hiking rates for the Fed is very, very high. I think you need to see a broader kind of reacceleration in growth. I think you need to see continued strong prints coming from the labor market for the Fed to consider hiking rates. I still think the bias is to ease from here, but more or less, this print so kind of solidifies a Fed that's on hold, and it's probably not going to be cutting rates anytime soon, even if you have a kind of Warsh-led Fed that is kind of keen on wanting to bring interest rates down here.
What else do you think is ahead for Kevin Warsh's new term? What are you watching for?
Well, so it's really interesting. Historically, what we've seen from the Fed and their broader communications is the role of the Fed chair is to kind of build consensus, right? So really be sort of a shepherd of views, if you will, for the broader committee members. And kind of the reading that I'm seeing currently is Kevin Warsh wants to make every meeting a live meeting, entertain all potential outcomes in terms of adjusting of policy rates. And so we could see the Fed seat kind of move from being a shepherd to head sheep, if you will. And I think that is going to be a bit disruptive to the market and how they price forward policy expectations on a go-forward basis. The other thing I would be watching for is it seems that Warsh wants to anchor sort of the Fed's view of inflation towards trimmed and mean measures of inflation, very similar to how the Bank of Canada tends to focus on inflation. The only challenge with that is the Fed has historically tried to be a bit more forward-looking with Fed, and with trimmed measures of inflation, you tend to underrepresent inflation when inflation is moving higher and overestimate inflation when inflation is moving lower. So I think there's a lot of some changes that we could see coming from the Fed under this new chair.
And the Bank of Canada holding rates for now. Is the oil spike likely to catch up, though, here as well?
Again, while the Bank of Canada doesn't have an explicit labor market target, it obviously still needs to be mindful and watchful of what's going on in the labor market. And a weakening labor market, I think, keeps the Bank of Canada on hold. I think the market is getting a little bit ahead of themselves pricing, a little bit over two rate hikes coming from the Bank of Canada. I think they're willing to be a little bit more patient. Again, their trimmed and mean measures of inflation over the last 3 months have annualized sub 2%. So I think they're in a position where they can stay on hold, even though the trajectory for inflation may very well be higher.
I want to ask you about the loonie as well, because it's falling today to some lows because of those unexpected job losses. But you had an interesting takeaway on the loonie and its correlation to the spike in oil and the conflict that's happening in Iran. Do you want to kind of elaborate on what you're seeing there?
Sure. So there's historically been a tight relationship between loonie and oil prices. However, that has kind of diverged so far over the course of 2026. And I think part of the reason is because these oil conglomerates are generating more and more revenues overseas. And so it's likely a lot of those profits that we're seeing on the back of higher oil prices are ultimately going to get repatriated in the form of dividends and buybacks, not necessarily being pumped back into increasing of domestic production. And so I think that is really the key that is driving sort of this divergence in what used to be a very tight traditional relationship of oil and the loonie moving together. You highlighted it as well. Some of the weaker economic numbers and labor market numbers might suggest that sort of the economic story there may suggest for, I would say, a stable to maybe modestly weaker loonie.
Got it. Okay, well, we'll have to leave it there. Jordan Jackson, global market strategist at JP Morgan Asset Management. Appreciate you joining us. Thanks for your time.
Thanks.
Coming up, for a growing number of Canadians, dinner out is becoming a special occasion expense instead of a regular habit. We'll have more on what that means for the restaurant industry when we come back. Stay with us. For many Canadians, dining out is no longer a regular habit. Restaurants Canada's latest industry data shows affordability pressures are reducing how often people go out, while Open Table data shows 65% of Canadians now see eating out as more of a special occasion rather than an everyday activity. For more, joining us now in studio is Kelly Higginson, President and CEO of Restaurants Canada. It's great to have you in. Thanks so much for coming.
Thanks for having me.
This is some interesting findings here. So more than half of operators say they're seeing fewer guests. Does this mean Canadians, they're not stopping going out, but they're saving restaurants for special occasions, right? So like how damaging is that to the industry?
Well, what we're seeing is because of that persistent and chronic affordability challenges that Canadians have been struggling with for quite some time, and then on top of that, our input costs continuing to rise, our operators are reporting that it's eroding their ability for profitability. And when we dug into that, it's 80% of our quick service restaurants have seen a decline in profitability, decline in traffic, the average check is less. And then it's 71% of full service dining has seen the same in lack of profitability. So when we peel that back a little further, what it looks like is it's that indicative of the K economy. It's the lower middle income Canadians that are having to pull back on their spending in restaurants because of the lack of discretionary spending being impacted by all of those affordability issues and now rising fuel costs for sure, eating into their discretionary spending ability.
When you say quick service, that's like more like fast food kind of restaurants or less sitting down.
That's
for a full
right.
meal? Is that what you mean?
Yes, it would be the fast food, but it is also then your cafes, anything where it's that counter service more than the sit down experience.
Got it. I wonder if there's any trends, like are restaurants still more full on weekends or for celebrations, but like empty midweek? Like is there a balance there even?
There is what we are seeing, and to your point earlier, is that people are saving it for, maybe that special occasion and not able to have it as that end of the week, busy working family. Pizza at the end of the week is now actually turning into pizza once a month. So really having to extend their periods of experiencing the restaurant purchases.
I want to go back to quick service because, as you mentioned, your survey shows like just over 80% seeing declining profitability. I wonder what that specifically says. Like, I know you were talking already about affordability. People just can't afford to do these things as much. But even the quick service restaurants, they do tend to be a little cheaper sometimes because you're not ordering a full meal. Maybe you're just ordering a sandwich, for example. Like, what does that say about consumer habits even there?
Well, it really is going back to that K economy. So it's the lower income and middle income Canadians that would be utilizing and frequenting those establishments more often, and they are having to pull back on that. There's a couple areas as well that we watch at Restaurants Canada, a couple barometers, and one of them is also consumer confidence. And as we see consumer confidence going down, we see the pullback in spending. When we see fuel prices go up, and that's for a couple reasons. One, obviously this dramatic increase in fuel is really eating away at their discretionary spending, but on top of that, people are traveling out less. So we're seeing less traffic out and about. People are really making choices around when and how they drive their vehicles.
And your trends over the last few years do show that this is because of inflation, higher prices, not habits that are left over maybe from the pandemic as well, or?
No, it's definitely connected to discretionary spending. And so 23 million times a day, Canadians make a purchase from a food service establishment. So we're definitely ingrained into their day-to-day habits at that kind of volume. But what we have seen is that the affordability challenges of the last couple of years, as those go up, then we see our spending going down because it's the first thing that Canadians have to pull back on. I'll say not that they want to, but it's that they have to.
Right.
Yeah.
I wonder then on the trickle-down effect, like what does that do for the restaurant industry, for jobs, hours, closures that maybe we're seeing around the country?
Sure. So I think that's one of the really important conversations that we continue to have with government. We're the fourth largest private sector employer in the country. So we employ more than manufacturing, auto, real estate, banking, agriculture combined, all of them combined. So what you're going to see, and what our operators are telling us, the levers that they're pulling, is cutting back on shifts, cutting back on hours of operation. So all of those things have an immediate impact on our employment levels and our opportunity to hire. They're also thinking twice about, should I be hiring? Because the first quarter of the year, I've seen this in the trend. I'm going to wait it out and make some decisions on whether I'm going to be hiring. But the other key is that they're pulling back on things like repairs, maintenance, and scaling their operations, renovations, and growth. And that's, capital investment and growth is a really important, portion of our new government's mandate and plan. And when we see sectors like ours as the fourth largest private sector employer, 4% of the GDP, really having to think twice about whether they make those decisions to reinvest and have their capital spending going, then that is where we start to see some trouble.
I wonder what it would take to kind of move the needle for this industry. Obviously, it's an affordability issue, and so some of that might be out of our hands. But what else do you think maybe the government could be doing? Could we see some tax reductions? What do you think? Is there anything that could help?
Yeah, absolutely. I mean, we're in constant conversations with the government. I think first and foremost, there needs to be a recognition of this sector as the economic powerhouse and job powerhouse that we are. So when we are putting policies together, let's recognize this sector. One of the areas that we're talking to the government about is the GST, and we're moving it off of all food. The great thing about having the GST holiday that we had last year, we have some really clear data on what that can do. One, it addresses affordability. So we saw an almost 10% increase in our sales, an immediate economic stimulus. We created 24,000 jobs in the month of January and February alone. Those are usually the months that we're pulling back. It's slow. We're cutting hours. There we were creating jobs. But you're also, again, addressing that affordability. The third piece of that is 40% of our workforce is youth. So we're also addressing the opportunity to create more jobs for youth.
Is there a world here, just quickly before we wrap up, where restaurants do need to prepare for like a permanently changed customer, though, as well, or need to maybe adapt to the way people are spending less? I don't know if you can adapt to that.
Well, I think our operators are certainly making those changes and trying to adapt to that. But I think what we need to look at is we are a big part of Canadians' day-to-day life. We've got the top line sales. We need to work with the government to make sure that there's a way for us to bring that down to the bottom line like we were able to.
Yeah, okay. We'll have to leave it there. Appreciate you coming in studio.
Thank you.
So interesting. Thank you for that. That was Kelly Higginson, President and CEO of Restaurants Canada, joining us. Up next, Amera's first quarter profit beat estimates, but the utilities company was weighed down by a stronger Canadian dollar. We'll find out more on that right after the break. Stay with us. Gas prices are hitting their highest levels in 4 years, and drivers aren't the only ones trying to adapt. Air Canada is announcing new reductions in its flight schedule, and at least one insurance company is no longer covering cancellations related to the jet fuel shortage. CTV's Andrew Johnson has more.
When Alexandra Antonovich books a flight to visit her parents, she looks for Air Canada's direct route first.
It just takes only 5 hours. Usually I would take connect flights, and that would be about double the time, even triple. With some strikes going on, it was once like a day and a half. So it's just convenient.
That convenient flight from Vancouver to Raleigh, North Carolina won't last long because Air Canada is ending the seasonal offering early on July 29th. The airline is also ending seasonal routes early from Toronto to Charleston, North Carolina, and Sacramento, California, plus Montreal to Austin, Texas.
The ones that they're cutting back are newer routes. They're not old routes. They're not LA's or San Francisco's. They're not Dallas's. They're not Chicago's.
WestJet also previously announced plans to slash its capacity by nearly 6% in June. John Graddick says along with the service reductions, Air Canada is primarily offsetting expensive fuel by raising fares.
You're in for some sticker shock because the prices have jumped significantly.
If you're buying insurance to protect you in the event of future cancellations, there is something else to consider. Manulife says it is now classifying the jet fuel shortage as a known event.
What that means is if you book travel cancellation or disruption insurance through Manulife after May 5th, problems related to this issue likely won't be covered. It might be a good idea to check with your insurance provider before making any new bookings. Andrew Johnson, CTV News, Vancouver.
Halifax-based utilities company Amera beat profit estimates for the first quarter with record results at one of its natural gas providers. And here to talk more about the results is Scott Balfour, President and CEO of Amera. It's great to have you join us. Thanks so much.
Thank you.
So tell me, what sectors kind of drove growth this quarter? What were the main drivers here?
Yeah, we really had strong performance almost across the portfolio, Lindsay. Certainly Amera Energy, which is a provider of gas transportation services, largely in New England, but a little broader than that. Had a record quarter, beating a record quarter that it had the same time last year, based upon certain weather events that was occurring in the first quarter. But we saw good performance in our Florida utilities as well, where we operate both gas and electric utilities in that market too.
A stronger Canadian dollar, though, did impact net income. Can you tell us more about that, and do you expect that to continue?
Yes, that's true. We have over 70%, almost 80% of our earnings are in U.S. dollars, and so as we convert that into Canadian, a stronger Canadian dollar relative to the U.S. dollar does have a small impact on our reported earnings. But largely, we actually do have a hedging program in place that does buffer those impacts, and over the long term, we've been able to weather and manage the volatility of current markets quite well.
And how did regulatory lags impact earnings here in Canada?
Well, so a little bit, yes. So we were pleased that we got a regulatory decision out of the Energy Board here, the regulator in Nova Scotia, to a all-party settlement that was filed late last year. We were hoping that decision might have been a little bit earlier in the year, but we have new rates effective May 1st that allows that utility to invest capital on behalf of customers, aligned with customers' expectations as part of this all-party settlement as per plan. So we're in good shape moving forward. And Nova Scotia Power, now like our other utilities, we actually have multi-year rates in place over the next couple of years, all the way through 2027. So we're in good shape across the portfolio from a regulatory perspective today.
Okay. Do you anticipate any other headwinds, though, to Amera's performance this year?
No. So certainly, I think we've, as the first quarter has demonstrated, we've got really strong momentum heading into the rest of the year. And in fact, we indicated to our shareholders today that we expect to exceed our earnings guidance of 5 to 7% this year, based upon that strong momentum that we started in the first quarter.
I also want to talk about Amera selling the Grand Bahama Power Company to the government of the Bahamas. Can you talk a little bit more about that decision and how this might impact future earnings?
Yeah, it really won't impact future earnings in any material way, Lindsay. This was our smallest business, and we serve 2.5 million customers across the portfolio, and about 20,000 of them are in Grand Bahama. So it's a relatively small business for us, and for the government of Bahamas, it supports a national energy plan that they're implementing. And from an Amera perspective, it really just gets us focused on our core markets in Florida and Atlantic Canada.
And I do want to talk a little bit more about Florida, because I see this was talked about this morning in the earnings call, is that there's some comments and discussions around data centers. Where does that stand? And are there plans for maybe more data centers in that area in the future?
Yeah, certainly data centers are a big topic within the electric utility sector for sure. And that has not really been a storyline in Florida yet, but that does seem to be changing. As we mentioned to our shareholders this morning, we have a number multiple data center discussions that are going on today, and multiple service agreements that are in discussion with these large load customers. And part of the support for that is Governor DeSantis just yesterday, in fact, signed a bill that is providing clarity as to the role and benefit of data centers in that market. And so that helped to clear a pathway as well. So we're quite encouraged, in fact, about the ability to attract large load customers into the Tampa Electric Service territory later this year.
With that in mind, too, do you have any other acquisitions, M&As planned for later this year?
Certainly nothing.
Maybe
planned.
not this year, but in the future. Yeah.
Mergers and acquisitions has always been part of our growth story over the years. We don't transact very often, as we, really stay disciplined around looking for opportunities that are both strategic and financially accretive to our shareholders. And so, we continue to look for opportunities and stay focused on that. But really, we're in such a good position today. We have so much organic growth in our sector, particularly driven by Florida. 80% of our capital today is going into the Florida market as we support growth in that market, that we're in really good shape as it relates to our growth opportunity, just with organic growth in front of us, with a $20 billion capital plan over the next 5 years.
I did want to ask, too, before we wrap up, you mentioned, the ongoing oil shock and the conflict in the Middle East, and how you've been managing to stay resilient through most of that. Are you anticipating more of a push for renewable energy because of what we're seeing coming out of the Middle East?
Yeah, it's interesting. It's maybe a little too soon to tell, and I think the dynamic can be different between jurisdictions. We've been investing in solar energy in Florida since we acquired TECO almost 10 years ago. Now, in fact, about 150 megawatts a year we've been installing in that market. Here in Nova Scotia, of course, it's not a solar story. It's a bit more wind, and the government of Nova Scotia, through the independent system operator, is investing heavily in new wind resources in this market as well. So there's no question that renewables are part of the future energy story. But as to sort of the impact as it relates to the conflict going on in the Middle East right now, a little too soon to tell if that's going to change the momentum in any particular way.
Okay. We'll leave it there. That's Scott Balfour, President and CEO of Amera. Appreciate you joining us today. Thanks so much for your time.
Thanks, Lindsay.
Coming up, Canada lost almost 18,000 jobs in April, marking the steepest 4-month decline since January of 2021. We'll get more on that right after the break. Stay with us. First quarter profit for Enbridge came in slightly above estimates, and the company has maintained its profit forecast for the full year. The Calgary-based firm also added $2 billion worth of projects in the quarter, bringing its order backlog to $40 billion. Enbridge says price fluctuations, rapidly shifting geopolitical dynamics, and unexpected supply disruptions have significantly impacted the energy landscape. And shares of OpenText are edging higher in today's trading. That's after the company's revenue and profit for its most recent quarter beat estimates. There was also an increase in revenue in its license and cloud segments. OpenText now sees full-year cloud sales growing up to 5%. And the federal government has projected a nearly $67 billion deficit for 2025-2026 in its latest economic update. That's almost $12 billion lower than the previous estimate. The update outlines several measures, including spending billions on training and hiring skilled trade workers. Still, there are some concerns the deficit room is being used to spend more. BNN Bloomberg's Amanda Lang spoke with Finance Minister François-Philippe Champagne, and he says given the fog of uncertainty, this move is to help Canadians in the time of need.
The concern of people is affordability. I think we have demonstrated we are a good fiscal manager. We have restored fiscal discipline, but at the same time, you have to be where people are. I mean, if we were to go on the street, the concern of people is affordable homes, it's grocery, and it's gas. So we've used, we had $7 billion of additional revenues. We used about 2/3 of that to help people now. We struck the right balance between using some of these revenues to help people, but also to reduce the deficit.
And you can tune in to Taking Stock with Amanda Lang today at 3 p.m. Eastern to see that full interview as Minister Champagne outlines the plan to get back to balance. And we're, of course, watching the TSX today. It is up ever so slightly at the moment, still at 0.4% today, hanging on to some gains it saw yesterday. If we take a look at U.S. markets, meanwhile, stocks are hitting kind of records actually today on jobs data, real strong jobs data coming out of the U.S. The Nasdaq is up 1.5%, and the S&P 500 up 0.8% at the moment. Canada lost nearly 18,000 jobs in April as U.S. tariffs and the conflict in Iran continue to weigh on the Canadian economy. The unemployment rate also ticked up to 6.9% as more people search for work. And we got more from Veronica Clark this morning, economist at Citi. Take a listen.
These monthly data are always very volatile, but they seem to have gotten even more volatile, if possible, over the last year or so. So they are incredibly hard to predict. And 1 month of a surprise is not necessarily new information. But that volatility does seem to be around a declining trend. And the details of this April data are also not particularly favorable. We saw job losses and more stable full-time employment. Of course, the most important detail is probably the unemployment rate, and that's been stable in this 6.5 to 7 kind of range, but it's on the upper end of that range now. So I don't think this is a particularly comfortable labor market.
And obviously, we're seeing the first 4 months of 2026 marking the steepest drop in jobs since 2021. What is behind some of the big decreases here, do you think?
Yeah, so one factor that it is important to keep in mind is that we have had a big slowing in the population growth the last year or so, immigration changes that add to that. So when you're just looking at the monthly employment numbers, that is going to have an element of just how many people are in the economy looking for work and wanting to work. So some of the slowing trend is that, but that's where it's more important to look at this unemployment rate. And that's going to be the best measure of how is demand for workers evolving in line with labor supply. How many workers are looking for work. And that's where, we've been somewhat stable, but in this elevated range. And so it is a bit of a concerning sign that even with the slowing in immigration and population and fewer people, in the labor force looking for work, well, there are fewer jobs for them also, and unemployment has not come down.
Yeah, because I take your point that that's part of the problem, the slowing in population growth. But how much does that really actually factor in, I guess, to the overall number?
Yeah, it's part of it, but that's again where we look at this unemployment rate, and that's the most telling sign that demand is weakened also.
For sure. Okay, when we're talking about sectors that saw the most losses, where did we see that?
Yeah, there was a lot of loss in goods, producing sectors, things like construction or manufacturing. Now, this is where we have seen some weakness over the last year. Those are going to be the more trade exposed kind of sectors. It's not so clear if, higher energy transportation costs would really be weighing on employment decisions as soon as April. It's only been, 1 month or so where we've experienced higher energy costs, but that would definitely be an added headwind for those production kind of sectors into the summer.
What about the sectors that are seeing strength?
Yeah, generally the less trade sensitive sectors over the last year have been relatively more supported, those services kind of industries. But trade and manufacturing in general is such a big part of the Canadian economy. A large share of GDP is still exports to the US, for instance. So even when you get the slowing in those trade exposed sectors, that's less income for those sectors, and you can see it bleed into other parts of the economy too.
It's always interesting also to break it down like region by region, like what parts of Canada saw what. So when it comes to like losses, but also gains in Canada, what region stood out to you?
Yeah, I mean, it's been, those more trade exposed kind of sectors in regions for a while. Ontario, we've seen weakness there. Nothing particularly really standing out in this report. But yeah, going forward, what you would expect is, maybe those more oil dependent, Alberta, those types of regions, maybe we see more strength there. Canada is still a very oil energy dependent kind of producing economy. And so maybe we see those regions improve somewhat. But for now, it's still relatively broad-based.
That was Veronica Clark, economist at Citi. Coming up, we will hear from BCE CEO Mirka Bibic about the telecom giant's latest quarter and earnings that beat analyst expectations as the company's investment in artificial intelligence infrastructure appears to be paying off. More on that next. Stay with us. BCE beat expectations on adjusted profit and revenue for the first quarter. This comes as the company continues its push to build out AI infrastructure and manage slowing growth in Canada's telecom sector. To find out more, we spoke with Mirka Bibic, president and CEO of BCE.
The catalyst for the beat in the quarter, Lindsay, were really fiber strength, continued fiber internet strength in Canada and the U.S. That would be one. Certainly, a very large catalyst was our AI-powered solutions businesses. We have three businesses at TechCo, which is our technology services division, Bell Cyber, which the name speaks for itself, and our AI data center infrastructure business with Bell AI Fabric. So those three businesses really had a incredibly strong quarter. And I think the third big catalyst was the strength of our digital media business, and particularly powered by Crave.
How much of that revenue growth was organic, as you say, the digital media side maybe, and how much was from M&A and the acquisition of Ziply?
Well, on the fiber side, it would be all in Canada would be all organic. In the U.S., the acquisition of Ziply Fiber in the U.S. closed last August, so we did not have Ziply's results in our consolidated results Q1 last year, so that would be inorganic for now. And in terms of AI powered solutions, it's a large part of that, frankly, is organic, and we opened up another data center at the end of Q1 in Merritt, BC, and it just shows you the momentum we are building on the Bell AI Fabric side of the house, where we have 2 data centers that are now live, one in Winnipeg, which will will go live at the early part of the second half of this year. And of course, there's the largest one of all in Saskatchewan, which is the largest AI data center infrastructure project in the country right now. And what we shared with the street yesterday was all the progress we've made in Saskatchewan, early earthworks, site stripping, doing a lot of work with local contractors. Is very exciting in Saskatchewan.
I did want to ask about the Saskatchewan data center because I think the last time we had BCE on, we were talking about that. So work has been done. When will you actually start to see revenue from that data center in particular showing up?
You'll start seeing revenue in 2027. So it's the complex will have 4 data centers on site, and we're going to be opening them up, going live one building at a time. So by the end of 2027, we should be at full run rate revenue of approximately $500 million.
Okay, going back to the earnings, it's interesting because despite a slowdown in immigration-driven population growth, BCE is still seeing gaining postpaid subscribers more than expected. Why do you think that is? What's underneath that?
It's so it is a low growth environment in wireless for sure. Given the slowdown in population in Canada, prices are coming down. So networks continue to be globally leading in the industry. I think everyone in the industry is delivering outstanding networks. So consumers are definitely benefiting from what's going on in terms of the price competition and the quality of the networks. In that low growth environment, however, we do have to manage that disruption from an operating point of view. And what we focused on is just making sure we encourage as many customers as possible to choose the Bell brand. So we're trying to encourage, and particularly focused on customers who are going to come to the Bell family and choose Bell for wireless, Bell for fiber internet, which is the best internet technology there is, and particularly our content and streaming products anchored by Crave, Crave on its own or Crave with in bundles, either with TSN or RDS or some of the other streaming products that we combine with Crave. So the combination of internet, mobility, and content's what's driving folks to the Bell brand, and you see that in the results in Q1.
We've seen some of your competitors within the industry slashing their wireless capital spending in Canada because of the regulatory environment. We've seen that of late. You've pulled back as well, but would you consider making even deeper cuts going forward?
Yeah, so if you look at our CapEx profile, our investments in 2022, we invested over $5.1 billion in our core communications franchise in Canada. And if you compare today to then on a like-for-like basis, our CapEx is now under $3 billion, so a significant drop. That said, we've invested additional CapEx in higher growth, higher return areas. AI data centers would be a very good example of that, with the Saskatchewan investment being really at the top. It's going to be a $1.7 billion investment for Bell over the next 2 years, much of that this year in 2026. That said, it's still, like you said, significant decrease in investments in what was the core business. And essentially, this shouldn't be a surprise. Our peers are doing it too. When you don't have an environment, a policy environment that's conducive to investment, naturally dollars are going to flow into other areas, and that's what you're seeing in Canada right now in what was the core communications business. And it's not just Bell. We just got ahead of it a couple of years earlier than some of our peers.
I want to talk about your debt ratio as well. It was 3.76 at the end of March. You're aiming to get that down to 3.5 times by the end of 2027. Can you walk us through kind of like your plans to do that and some of the headwinds you might be facing in trying to achieve that?
Yeah, so we're clearly on track. You're right. We gave that target of 3.5 by the end of next year. We're going to hit it. Absolutely. If you go back a year ago, in February of 2025, actually, we indicated to the street that we were going to get there in part by divesting of non-core assets, and we said at the time, we were hoping to generate at least $7 billion in proceeds from those dispositions. It's 15 months later, and we've already announced $6.6 billion of divestiture. So that just essentially our plan is we set targets, we communicate them transparently, publicly, and we track our progress against them, and we communicate regularly, and we execute what we say we're going to do. And this is a perfect example, already at $6.6 billion out of the total of $7 billion. So that's one of the major catalysts to get to the 3.5.
We're seeing churn in your mobile business up last year, though, due to competition kind of in that telecom industry space. What's your strategy to kind of reduce churn while also avoiding excessive spending cuts?
Right. So we had significant churn improvements over the last few quarters. Q1 of this year, so the first 3 months of this year, were anomalous. It was unusually competitive quarter typically Q1 is slow. That wasn't the case this year. So I think you saw everybody's churn go up. Our strategy, one quarter doesn't make a trend. So our approach is to continue to get churn down. We've given ourselves some targets over the next 3 years as to where we want churn to be. And the way we're going to do that is going back to one of my earlier answers, Lindsay, is to drive as many consumers as possible to the Bell brand, which is the premium brand, and encourage them to purchase fiber, internet, wireless, and content. And if we do that and we execute well against that, our churn will come down.
That was Mirko Bibic, President and CEO of BCE and Bell Canada. And a reminder, of course, that BNN Bloomberg is a division of Bell Media, which is owned by BCE. Still ahead, today's market movers with Bloomberg's Natalia Nikevich. Stay with us. That's next. Welcome back. Joining us now for some movers south of the border is Bloomberg equities reporter Natalia Nikevich. And Natalia, it's great to have you. Thanks so much for joining us. So we're going to start with the latest on investors' sentiment as stocks kind of rally to an all-time high today. We're seeing a lot of green. What's going on?
Yeah, so we saw a really solid jobs report today, which overshadowed a separate report showing some concerns over U.S. consumption. Consumer sentiment is, of course, moving lower as many consumers are concerned about the impact on inflation coming from the war in Iran. However, for now, everyone is so bullish. Yes, we see stocks trading near all-time highs. We saw retail traders data coming from Citadel Securities, which showed that flows and activity across U.S. stocks now jumped to the highest level since 2019. We saw lots of call options buying, which indicate that retail traders are bullish on the U.S. stock market. Separately, some sentiment indicators tracked by Bloomberg Intelligence are showing that stocks are trading at manic territory, so sentiment is really very euphoric. However, we hear that more and more strategists are now pointing to this divergence between the stock market and high-yield bond market. So, for example, when you look at junk bond ETFs, they are moving lower, and historically, these divergence suggests that sentiment is not as great beneath the surface.
Very interesting. You're also watching shares of Lyft today. Earnings there missed estimates after a global expansion push. Tell us more.
Yes, so shares are down today. First quarter earnings per share came below expectations. We know that Lyft has been spending heavily on international expansion. We know that the company has been working to integrate European taxi app, and looks like those efforts will start to pay off in the second quarter, because the company said that gross bookings for 3 months ending on June 30th will be above the company's target. Previous expectations, I should say. But overall, many people are quite bearish. As you can see on the chart on the screen, we see that the stock is down by more than 20% on a year-to-date basis. So it will be a long way for recovery for Lyft shares.
Mm-hmm. On the flip side, Airbnb, that's another stock you're tracking today. It's up right now, almost 3% at the moment after an annual sales outlook. Tell us more.
Yes, so sales outlook came better than expected for the full year. For the second quarter, also outlook came better than analysts expected. We know that the company has been spending heavily on efforts to diversify its business. We know that now Airbnb is adding some so-called a la carte services in select markets, Instacart grocery delivery, pickup car services in the airports. And what is interesting is that we see a divergence in terms of how travel companies across the travel sector see the market. We know that Airbnb is optimistic, which suggests that they see a rebound again in global travel market. But we also heard from United Airlines, American Airlines, Booking.com, and those companies, they cut forecasts because they are concerned that the war in Iran will really have a negative impact on travel market. Airbnb did say that they saw increased cancellations during the first quarter due to the war in Iran, but overall bookings still jumped by 9% from a year ago because they saw much stronger growth elsewhere. And the last point, Airbnb said that the World Cup is set to be the biggest hosting event in its history. I did not check, just out of curiosity, prices for Airbnbs in New York or United States during the World Cup, but I assume they are moving sharply higher.
Yeah, that's going to be an interesting one. That's a big story here in Toronto as well. Okay, we'll leave it there. Bloomberg's Natalia Kinajevich joining us live. Natalia, thanks for that. And we're going to take a quick look on the markets here before we wrap up. We're tracking the TSX, of course, today. It seems to be in the green at the moment. We'll continue to watch that for you. Also, U.S. markets, as you heard from Natalia, boosted today, particularly on some interesting jobs data that we got out of the U.S. And we'll continue to follow this for you throughout the rest of the day. The Nasdaq up 1.5% at the moment. That wraps up this edition of Trading Day. Thanks for watching.